Chapter 10, Stockholders' Equity. In this learning objective, we'll be discussing recording the issuance of common stock. We can think of common stockholders as the true owners of a business. In most cases, each share of common stock represents one unit of ownership. For our discussion in this chapter, we need to make clear the different number of shares a company may have. First is authorized stock. Authorized stock is the total number of shares available to sell as stated in the company's articles of incorporation. So for example, say that a company has authorized stock of 100,000. 100,000 would be this entire circle, the entire amount authorized to issue. Then authorized stock is either issued or unissued. So you see the 50,000 and the 50,000 equals the 100,000. If it is unissued, that means that the company has not ever sold the stock to any public owner. It is still in reserves to be sold at some point in time. Issued stock is the number of shares that have been sold to investors. The total number of issued shares can then be broken into two categories. Outstanding stock is the number of shares held by investors. Only these shares receive dividends. The second type is treasury stock. Treasury stock is the number of shares repurchased by the company. So if you notice, my outstanding and my treasury equals my 50,000 issued. So my issued is either outstanding, still in the hands of owners that dividends are paid on, or bought back and owned by the company. They have been issued at some point in time to an investor, but the company has bought them back. So treasury stock is part of issued stock. It's not outstanding because it's not available to be traded. It is owned by the company. So authorized, available to sell, issued and unissued. Issued are shares actually sold, outstanding plus treasury stock. And then outstanding are the shares issued and still held by investors. Lastly, you have treasury stock, shares that have been issued and repurchased by the company. Par value. Par value is the legal capital per share of stock that's assigned when a corporation is first established. Par value originally indicated the real value of the company's shares of stock. Today, par value has no relationship to the market value of common stock. For instance, Facebook's common stock has traded above $100 per share since 2015. But its par value is 0.000006 per share. Laws in many states permit corporations to issue no par value stock. No par value stock is common stock that has not been assigned a par value in the Articles of Incorporation. In some cases, corporation assigns a stated value to the shares. Stated value is simply another way of saying par value. So, accounting for common stock. When a company receives cash from issuing common stock, what's the journal entry? Well, it depends on if it's par value or no par value common stock. Well, first we're going to look at Canadian Falcon issuing 1,000 shares of no par value common stock at $30 per share. This is the transaction that you have seen before and that you know. We debit cash for the total amount of cash the company receives, 1,000 shares times $30 per share, and we credit common stock for the entire amount, the $30 per share times 1,000 shares. So this transaction that you have been recording has been for no par value common stock. But let's assume that Canadian Falcon issued 1,000 shares of 1 cent par value common stock at $30 per share. So what this is saying is that they're issuing 1,000 shares that have a par value of 1 penny, and they're receiving $30 per share for those shares. The debit is still to cash for $30,000. We know that the company is receiving $30 per share for the 1,000 shares, so that doesn't change. The difference is in the common stock amount. Common stock needs to be recorded at only par value. So your 1,000 shares times your 1 penny, you would credit common stock for $10. When you have par value common stock, you need to credit the common stock account for the number of shares issued times par value. The difference between the two, between the amount of cash that you receive and the par value of the shares, goes to this new account called additional paid in capital. Additional paid in capital is an equity account, and it has a credit normal balance side. Additional paid in capital is a way to keep up with the difference in what the market value is and the par value is. This is an account that holds that difference for us. So if you have par value shares, this is what your journal entry looks like when it's issued. Cash for the full amount of cash received, the $30 per share. Common stock is the shares times the par value, and then additional paid in capital is the difference. Lastly, it is important to note that common stock and additional paid in capital are both stockholders' equity accounts with a normal credit balance.